What it is. I'm sharing my coffee with your monsoon. Jason.
Thank you very much, everybody, for coming tonight. My name is Chris Edwards, and I'll actually working first on behalf of the Harvard Law School Association. I'm on the board, and I wanted to first thank Joseph Gerstel for coming to the idea of this event. As a board member, this is your organization. You love ideas for events. So if you have any events you'd like to have, bring in deals of interest, like have this on, I'd love to hear from you. And secondly, welcome you to behalf of my firm, Rosenblatt, we focus on venture capital and startup investing, startups and angel investing. So we were thrilled to host tonight on the same. So it's really after the panel will be time for more drinks and you're welcome to stay around and meet each other. So if there's other going on, welcome to us first of all to everybody. Thank you for being here.
Thank you, Chris. And thank you, Chris, for being my partner. I guess the very responsibility for the event on the team because it really is instrumental. So thank you very much, and thank you your firm for hosting us. So that's you try to put it in an event. It's going to be that someone just steps up and provides it. So thank you very much. Hey everyone, I'm Joseph Gerstel. I graduated HLS 2017. I chair the programming committee as of last year, so of the recent grads network. And my goal is to put on awesome programs like this. And just to give you a little bit of background context of what my interest is in doing things like this. So I went to HLS, conservative, didn't know what I wanted to do, so took the conservative risky path and ended up in big law and realized I didn't really belong there, and I probably got there because I had insecurity about what I was going to do and self-doubt and this like trajectory, which was not me. So I found my way out during COVID, built a company and doing events. It's opportune at the time and opportune. But I left and I've been scraping away personally at this doubt of my own by putting myself out there a bit. And I also realized that I think there's lots of other lawyers that end up kind of in some sort of box of a sort rather than one that they create. So my goal with a panel like this on getting into VC is just to say, hey, if you're interested in something like this, the door is open. How can we seed the beginnings of insight as to how you might begin to progress in walking on this particular path? And it may not be this path, maybe it's writing a book, or maybe it's going into litigation finance or becoming a dancer, whatever it may be, and maybe it's on the side of what you're currently doing. It's however we can kind of expand our personhood in one form or another. So my goal is kind of to encourage myself to apply and encourage other people to apply while I am doing so in a way that has self-reinforced very nicely and beautiful. So that's kind of where the panel is coming from tonight. Very briefly, there are two things that I do that may interest people here. One is I write a newsletter on Living Advice Life. Ivan, I think we have a sign-up sheet. If any of you are interested in that, sign up. I also have tried to do a bunch of community building around lawyers around particular shared interests. So one thing that was that the community has been very interested in is lawyer founders. It's part of this idea of how we support lawyers and going out and being courageous and trying ventures. We actually ran a pitch session, which all the panelists were at, between lawyer VCs, lawyer founders, a lot of lawyer audience, which was very well. I think you guys said that you would come back again, so that tells me it was good. So there's and I just run it on WhatsApp, very efficient. I have 5 or 6 different groups around various interests, lawyer investments, lawyer entrepreneurs. There's a small firms chat, there is a GCs chat, and these are just ways of bringing people together in simple ways to build some community around some shared interests. If in any of those, part of them, and they're interesting or valuable, you're welcome to reach out to me, and happy to have you here. So the program for tonight is I'm going to ask each of the panelists to introduce themselves, and then we'll have 20 or 25 minutes of moderated questions, and then we'll open it up, and we'll have unmoderated, hopefully very feisty, direct, awesome questions. And we will try to include the folks on Zoom as well, and take a question or two from there as well. And you're also more than welcome to turn on your cameras, you can see your faces, it's pressure, just some subtle coercion over here, but you're welcome to go in and feel like you're in the room with us, which we will also imagine that you are. So without further ado, we'll start from the corner. David, introduce yourself.
Sure. Hi, I'm David Hornik. I know a few of you who took my class at HLS, so thank you. Appreciate you taking. A short version is I got out of law school, I clerked on the Second Circuit, I was a litigator at Cravath. I left and became a corporate licensing attorney at Venture Law Group, which then collapsed. It wasn't my fault. I joined Perkins Coie to help form their corporate practice in the Bay Area, which I was the 11th attorney. My now partner, Buddy Arnheim, was the 12th. That we then recruited a bunch of people in the next year and a half. And I left the firm. We were at 65 attorneys in the Bay Area. And in 2000, I joined a firm called August Capital. August had been one of the earliest high-tech venture firms in Silicon Valley. The partners at August were the earliest investors in Microsoft, Sun, Compaq, Intuit, and a bunch of interesting companies. When I joined the firm, they said, David, lawyers suck at this, but we like you. And so we'll give it a try. And if it turns out you're not good at it, well, you can always be a lawyer. Well, sounds fair enough. 5 years into being a VC, I went home and said to my wife, I had this realization today that while it's not clear that I'm a good venture capitalist, it is clear that I'm no longer qualified to manage. Said, shouldn't you have thought about that? I said, yes, fair enough. And in year 11 of being a VC, I took a company called Splunk public that I had been the very first investor in, turned out to be a multi-billion-dollar company, and they declared me VC now for 23 years. After 20 years at August Capital and running August Capital, decided to raise a fund as Lobby Capital based on a conference that I run called the Lobby Conference, where I'm currently investing Lobby Fund. And I've had the pleasure of taking 4 companies public over that time frame and seeing a lot of amazing stuff and also watching a lot of companies crash and burn. Welcome to
Jason Sherman, nice to meet everybody. Inspired me all the way through my career. I did a couple of years at Davis School in the corporate practice as well. Then I was fortunate enough to get a call from a friend who had turned down the job and I was pushed in bed. They were just forming within a disruptive growth organization and maybe in the global disruptive group. Just a couple people in that space. They had to come in for a lawyer. I joined and we went from, hey, here's $20 million, which is not a lot of money in terms of a $60 billion business, to go spend on different global ideas. The CEO comes into the room one day and says, the board really likes what you guys are doing. Spend $1 billion. It's we, a few of us, what can we do? A lot of smart people, a lot of places, and I got the fortunate position of doing, I think I managed 800 different venture capital acquisitions for investments or building like a team in different countries all around the world. It was a lot of moving around. I lived in 15 different countries in 2 years. And I got to see a few things. One, e-commerce in its earliest evolution in the beer space. I mean, most of you probably haven't yet to buy beer online today, let alone 70 years ago. So I saw a very early global thing. And then similar to David, a lot of the guys were people there. And as opposed to the Brazilian capital, that's a problem. But they asked me, hey, we know you're doing well on the execution side. You'd like a little budget to try out the US, which if you don't know, incredibly regulated out in the space. Very, very regulated. And they needed like a legal mind to figure out how e-commerce was going to work. It's kind of early. And they gave me a little budget, a little team. And I found a couple guys in Boston running a liquor store selling liquor and beer online, which ended up being interesting fellas. And I gave them a little capital. We actually turned their model around so that us then as opposed to give them marketing dollars, which regulation wise is kind of a iffy thing to do. But we did it in a way that we thought was going to work. We ended up getting all 50 state liquor authorities to approve it as a model. The if you don't know the story of Drizzly, they ended up with like 30 occupants from mini bars, now Uber Eats to Grubhub to Seamless. So we kicked off a whole evolution of space. And then around 2019, I decided to go ahead and try myself. Drizzly was not a perfect model. Again, most of you probably had worked on along with it. So I knew there were a lot of issues in the space, and I tried it myself. And I went out in 2019 and launched a business, TapRm, which today is the largest provider of beer online to beer brands. We support hundreds of beer brands online, their websites, with distribution. We made it very simple for beer brands to launch without all the archaic regulations and middlemen they have to go. And then about a year ago, I started my own venture fund. In seed stage, I'm a whole brand partner. We're smaller than these get $25 million fund. We only invest into very early stage brands that are doing well. So that's like one criteria we have, because one, we know we have best for alcohol brands online.
Jason has thrown down the gauntlet to me, which I realize he was too big to bring him a brand he hasn't heard of. So please help me out.
Which the real reason we did next, we can pick winners. So we can make our LP. We'll talk about insurance here, but it's definitely been an interesting year.
Can I just say quick, you mentioned that you got this call from a friend, you've been out, I had lunch today with a friend of mine who similarly was at a law firm, second, third year associate, on a call, picked it up, stupid little startup that was trading, doing trading online. The only reason he got the job is that they were going alphabetically, and his friend Alex Ben didn't take the call. He took the call, became the first lawyer at eBay, and then helped grow that. That went very well. So you might consider answering the phone. I don't know. Can't hide their butt. eBay is pretty good. So
There's people calling me.
keep thinking about it.
My name is Joe Lieberman. I started my career in the healthcare space in 2009, doing a small healthcare company, the largest privately owned healthcare conglomerate. While there, I founded a tech company that I continue to grow while I'm in law school at Harvard. Cornell consulting company, started investing after law school. Continued to invest, but I worked at, I also went to math for 2 years. Really enjoyed my time there, but I knew then I ended up staying law. And then in 2018, I found fund. We invested in early stage SaaS, mostly SaaS, enterprise SaaS company, B2B SaaS.
Yeah, so I'm just gonna bounce that right back. So if each of you could tell us what your fund focuses on and why you chose that focus, that would be great. So B2B, early stage SaaS, why? Tell us a bit more about it. Why I send you some deals that you pull out and say this is not our focus. Why did you land on that?
Well, Jason probably knows this better than I, but D2C really tough business to do, right? Your
D2C direct.
direct to consumer businesses means you have to make over and over and over again sales to consumers. It has a massive scale, but a successful D2C company usually has a lot more ability, bigger than your average B2B success story. But it's a really difficult process for most D2C companies that we see are product companies. You have development, manufacturing, shipping, freight, sometimes regulation and licensing. You have the cost of customer acquisition costs, not have sticky customers often, which leads to churn. So in the B2B space, it's a lot simpler for us because you're dealing generally with the value proposition that we look for is you're going to business and you're in some way bettering the way they do business and saving them some way, somehow you're making them their ability to do business easier and better. And generally, B2B are longer term contracts, they're more predictable customers, they're easier for us to diligence. The customer acquisition cost is not, it's a much different model than your B2C customer. So we find it to be easier, more reliable business to diligence.
There's no churn in Allen. That's some of you.
So mine's it's great. Like when I wanted to you haven't worked lot of money majorly. But the real reality for them was how do we protect what we do? How do we own distributors around that sell the restaurant, what's new, what e-commerce is doing, like let's make sure that no one else can do it no matter how much it's like we run Stella and Budweiser and Corona globally, like what's new, Hornik, which is kind of they're like it's like seltzer, let's get it. It doesn't matter how much we spend, like it's a very different mindset. And when I was beginning my venture, like after transitioning out of my startup, I knew that investors would be making them money and support it, like by far. And they would be like, yeah, like the LPs are what really matters. Like your first fund, you make that money the first time, you're gonna come back to you the second. So I said, what's the easiest way for me to make my first set of investors spend money? It's like I know the best, which is brands that do well online. And there's only like 6 platforms. Like it's only 6 platforms, one of which is mine, that sell alcohol online in the US. So I just get all the data from all 6 of them and find out what brands are popping off early. I can easily just go invest in them first. There's not that many people investing in alcohol to begin with, because there's like ice clauses in almost all the major institutional PE. So there's very little money in the space, especially. So if I can just get in early, invest, and all of a sudden these with my money, my connections, my partners, and even advisors, all the major suppliers, we can turn them from these 10K a month online brands to $1 million a month distributed brands in traditional distribution, and they get them acquired in like 24 months. It's already starting to play out. And I knew I just run that model, like 7 or 8 investments, and then each year for a couple of years, I could return the LPs, my first LPs, a ton of money. It's starting to work, and I'm hoping for us this goes the way I hope in the next couple of years, and I can open a much more broad fund. But mine's super specific for that reason.
How's the Stellar one?
It's delicious beer. My wife works at Indian Bear, so yeah.
This is being recorded. That's good. Dave, you wanna go ahead?
Yeah, I was just on a panel talking about the venture in the downturn. The question that was asked to the panelists was, what are you excited about in 5 years? The first person said, artificial intelligence. The next person said, artificial intelligence. And I said, software. They were like, well, then I said, all right, what are you excited about 10 years from now? And the first panelist said, artificial intelligence. And the next panelist said, artificial intelligence. I said plastics, but then I said software. That's what software is the greatest gift to technology investing ever. You build something once, you sell it forever at no additional cost. Like there is no better. That's the SaaS model too. SaaS is even better. It used to be that if you build something for an enterprise, you charge them $1 million and use it forever. And then someone woke up and said, if I just charge you $1 million a year, how about that? And everyone went, that sounds bad. It's no, that's better. And that's the SaaS model. So I invest in enterprise, boring enterprise software, infrastructure, how do you build these things? I invest in fintech and payments and occasionally still invest in consumer and rules my money. So
I just want to follow on here for a second. So the SaaS landscape, your secret anymore, and it's kind of exploded exponentially. What does that look like 5 and 10 years? Is there ever an end to it with each of it such that as new technologies come out, there are now new opportunities that are now new SaaS opportunities?
yeah, I mean, if you look at the history of enterprise software, it was okay, we built software that helps you run your business. People were like, that's amazing. And then someone else came along and said, if we had a lot of data, we could do that exact same thing better. And then they created data-aware software that ate the lunch of the non-data-aware software. And people said, oh, that's amazing. And so what we have now, artificial intelligence is amazing. It's going to displace each of these things, right? We're on Zoom now. There was the equivalent before. It just started out Zoom was a better version, and now there are companies that are better versions of Zoom. We'll see that time and time again. So what's extraordinarily hard to do is invent the space and then stay at the top of that space forever. Right? That Microsoft has reinvented itself now. Is this incredible powerhouse is miraculous. My partner Dave, who was the only private investor at Microsoft, sat on that board for 33 years. They made more money every month over month for 31 of those 33 years. That's unimaginably hard to do. Mostly you find a company that does really well for a decade and then something goes and eats it. That's fine with me. I'll fund the next thing. You know, that's what our job is to find the next version of that thing that's going to replace it and make it better. And we've seen that.
Okay, so I wanna cut off your careers and be back in Irreverent, Facebook, as an associate, and you're not getting any lucky this time. How would each of you go about starting today to get into venture? And would you get into venture? Or would you say all the concepts? So, do you come up first? Sure.
I think there's different ways to get into venture. And I speaking my own experience and what I think makes the most sense for most lawyers, at least if you're similar enough in personality, which is, you know, there's certainly some venture partners who are excellent relationship. They're really, really great at getting quality deals, and a good eye for a company that's really shining in the space, and that's got, you know, really good founders, but they're not necessarily strong at the analytical elements of Joe, really understanding the company, the financials, the product, the competitive landscape, what kind of. So I think as a lawyer myself, the way I got into venture was non-traditional in the sense that I went to work with some venture firm, career there. It was the contrary. Is I came into some money from an exit on my own company I had built, and then wanted to put that out and invest and say, okay, here should I allocate this money? And then started doing diligence myself and saying, okay, you know, this company's out looking to raise capital. Let me try to understand everything about it. Try to understand the founder backgrounds. Let me try to understand the niche. What is the market opportunity here? What do they look like at scale? What are their competitors doing? What do their financials look like? What is their projections? Does it make sense? Can I speak to a customer or two? Can I get it? And then I would build a thesis of why I thought this company made sense, and I would send it out to friends that also wanted to allocate resources, and they liked it. And so this is a really good, you know, we were invested in this fund and that one, we're invested in really brand name funds. And they said your analysis is as solid as that, which gave me the confidence to say, well, maybe I do know what I'm doing. And it's really the same analytical tools you would use, you know, to do a deal and negotiate a term, but you know, kind of turning that and see, can you get a broader market view and then get a really micro view of this company within that broader view? Are you comfortable digging into financial, really understanding it? Do you have a good eye and understanding? Can you really grasp a market, where it sits and how sticky can it be? So, you know, just by trial and error of doing the hard work, of doing that diligence, sending it out, getting that application, making investments, and then seeing success from that, you know, and over time, it just grew into a point where you start building a following, and then people want to invest. They trust your deal. They see you've had success. You have an exit or two for a few years, and that's how I built my fund. It was more just sending out thoughts. Started grew into a following. Had some actual exits, and said, okay, maybe I do know what I'm doing. I should do this formally, and then form my fund. So I can't speak to the other approach, which is leave your firm and then work for a venture firm. So I really don't know how that works, but that worked for me. I think what is it a good way to test it while you're still doing what you're doing is do the actual work, send it out, and get some feedback.
And so you do the work by getting the deals somehow.
Yeah, so I because I was in the startup space from my own startup, I had some access to relationships to other founders, and then I was aggressive. I was always reaching out to Accelerator plus other schools to say, hey, do you have any deals? I'm looking to invest. And just, you know, if you have money and you want to invest, people will send you deals. So, you know, then just going through that, asking questions, going through the motions, speaking to the founder, getting their understanding, doing the work, diligencing other companies, finding competitors, doing an analysis, building out a thesis is really the grunt work of seeing, do you have the to do this as well? So that's, you know, I just was mailing deals while I was at Irreverent, very super annoyed every other 2-3 weeks nowadays for a waiver and invest. Let's sign off on it. None of these companies they ever heard of, if they were startup companies. they're thinking more about trading securities, but you know, ultimately that, you know, that was a source my own deal, which anybody in this, you know, you just reach out and say you can invest in see deals, get deals, just go find them and then do the work of actually digging deep into them. You know, you're looking at probably 10Qs and 10Ks and thinking about the, you know, the disclosures, but ultimately in those documents, you're also, if you read them and understand them, getting a really good understanding of, you know, at least what the company is saying about itself. Can you look behind that curtain and get your own thesis of what's really going on? It's not that.
Right. I remember when I was in at Gerstel, they were hearing had a great venture capitalist. One of the four things about it was you can source a ton of deals. You have a huge breadth to look at. You can analyze deals, so you can source them well, but like you can pick one that's good. You can add value and you get involved with anybody so that you get huge. You're the kingmaker of the group, or you just raise a ton of money. You have access to capital. So you're good at that because you're just. And I remember thinking, I've none of those. I was a James Bond guy, literally none of those. I had no idea what I was doing in its fronts. And I remember as I started progressing, I don't know how much I would have changed. Because like when you're at a law firm, your analytical skills get really intense. Really when I was a corporate lawyer, like I was like digging into these documents for a company to really see the shit they had, right? Like you can see everything going on. You start to understand some of the issues of big companies. But you also start to like really understand how businesses operate and get ready. So you really analyze and you get to know financials better than some players want to do, but you can dig into financials too. Then when I was in house at a big company, I saw how a big company can add a lot of value. They began to do these startup, like what they were doing to Kingman, right? We took a right, and we made it into a huge brand all of a sudden, but not because the brand was any good, but because they have that access, they have that value, so you can see where the value is coming from. And then very lastly is raising capital, right? Like I learned that from my startup. When I was out there, you have to grind to raise money as a startup. It's actually much easier as a venture LP. Venture is much easier to raise for because the money's a lot less risky. Like when you're getting people to raise, when you're pitching business, you can lose all their money in like 6 months. They have no idea. So you're really pitching an idea.
Instead of 10 years.
Right. So you gotta get all those pieces together throughout your career. Thinking about it. Just make sure you get the right chess piece, or at least be really good at one, or know the people with the others that you can complement. So I don't know how much I would have changed from day one. I'd highly recommend some sort of specialty have, even if you have to go in house at an industry you're interested in, learn that industry. If you can get an innovation, learn innovation to operating within that industry before making the jump into the venture. That's certainly my path. It's one.
I mean, I think if you want to be a good venture capitalist, and certainly if you want to be a great venture capitalist, you have to do all of those things, right? I've taught for lots of years in the Calvin Fellows, which is sort of the intro to venture capital. Okay, spent 2 years learning how to be a VC, and so I get in there to start off the conversation and say, well, all you have to do is see great deals, and then you can be a great VC. Well, no, not really. First, you have to see them, and you have to recognize they're great. But then you also have to win them. So you have to convince people. And then after you win them, you actually have to help them be successful. And then once they're successful, you have to actually figure out how to get them liquid. And once you get them liquid, you have to actually distribute the capital before it goes to zero, which a bunch of people have unfortunately recently seen. And if you can do all of those things, then you're good at this job. And if you're not good at any one of those things, you're probably not going to be good at this job, which is really hard because no one of us is qualified to actually do all of those things. I was not qualified to do any of those things, but I became a venture capitalist. When I joined the firm, I had a computer music degree, a master's in criminology, a law degree, had been a litigator and a corporate attorney and a licensing attorney. Awesome. I could play the bass. So I was like, sweet, perfect for venture capital. But when I described the job to my mother, I said, oh, here's what it is. She's like, what the hell is a VC? I thought you were a respectable, lawyer. I said, no, VC. She's like, what is that? I described it. Her response was, oh, you talked your way into a job that only involves talking. I said, that's precisely correct. She said, it's perfect. And that's sort of true. But I have to say, what you should do as a young, as a leader, someone who's engaged and interested in business, you need a giant. Like the rest of this stuff is really not that relevant until you actually get to hear about interesting and exciting things. And the way you do that is by building a set of relationships. You can do it in a specific vertical. You can say, hey, I'm a SaaS person, so I'm going to know everyone in SaaS. Hey, I am the investor in next generation alcohol. Great, that's incredible. Get to know everybody that's relevant. Or you could say software and people go, that's insane. Know a lot of people, get to build relationships, pay it forward, help people be successful. And eventually they want to help you. And then you might see interesting deals. And then you get to see whether you get the rest of them. And we're going to get to the ways in which we all got it wrong. Because that's just part of it. We're going to start with the good news is if you have one of these horror stories, it means you got to see it, so you can give yourself some comfort. I was once trading emails with a very arrogant entrepreneur who was telling me that their business was going to be worth an unimaginable amount of money, and blah, blah, blah. And eventually that entrepreneur was sick of me saying no. And he said, mark this day, David Hornik, because it's the day that you made the worst mistake of your life. My response to him was, I turned down the Series A of Facebook, the best venture capital investment ever made. Used it as and that's the reality. Right? I mean, if you're lucky enough to get in front of these businesses, you'll get them wrong. Facebook, I thought, was too expensive. They wanted to move around at $100 billion company. I turned down the Series A of Uber. I had backed both of the Uber founders before, and they met each other at my lobby conference I run. And I said, how big a business could that be? Running Uber black cars. And it turns out that wasn't the business. Whoops, that was good. Turned down Twitter, not because I didn't love Twitter. I love Twitter. I just didn't love the founders. You know, it turned down Palantir. I didn't know what the fuck they were doing. They couldn't explain it. I mean, so business is about disappointment. They turned out to be really big thing. But it turns out what you have to do is invest in some great company. You don't have to invest in all the great companies. And you know, I love this. Like, oh, we spent a couple of years to start getting to outcomes. It took me 11 years, 10 years into the venture business. Which why are you letting me still be a VC in 10 years? But 10 years into the venture business, I sold 3 companies and I was plus $70 million. I had lost 3 companies that got out of business and I was minus 30 from those. So I plus $40 million in 10 years. Wow, you're bad at this. You know, that's amazing. But year 11, you take a company public and suddenly you're good. Right. So it's a very strange business and it's a very long-term business. But if you fund amazing people and you ultimately support and believe in them, if some of them work, then it's an incredible business. I mean, I can't believe that I'm 23 years and there's years in and there's still money.
Yeah, I think for me, the lesson is it's great people. Really, that was sometimes you look at businesses, especially early stage businesses, it's a great business, a great brand, and in a couple cases, like a great company. The people are horrible. I'm going to do it instead of that, you know, for any other reason. And then that hurt me pretty bad a couple of times. And you know, I got asked to look into the home brewing supply space. It was kind of growing in 2017. There was one player, Northern Brewer, which was the #1 online seller supply. So it was run by these private equity folks, like evil. And they knew they were going to walk away. They signed contracts saying $60 million a year company, probably in a how much they're selling on like that month, basis. They were trash. And probably intentional, right? Like, and I remember we pitched the investment committee. So, okay, we need another $10 million to invest into the business to grow the marketing channel. That didn't work 6 months in, but nothing had invested. We asked for another 10. Right? 18 months later, there was no good people there. The whole market left. And we had to sell it for reports. So there was no money. It was a margin, it was good profit. The whole space had started to crater and there were no good people. And that's the way like, we all knew the warning flags had to be. Don't. And I think even at the earliest stage when I'm looking at brand, the number one thing, obviously you have to do well, like your e-commerce data has to be strong, you have to have strong retention, but like, if I talk to you, I think you're lying to me, or I think you have no idea what you're doing, or your execution is weird, or you're like way grandstanding, and the next time I talk to you, you're like hiding stuff from me, that's gonna be really problematic, and I think that's, for me, the number one.
So I found here was I missed this. But in the same reason. Not understand the business so much. I don't really regret them. We really didn't invest in a company. Tilted. But the one that bothers me the most is an investment in making the company that business was sound, software business, a lot of good qualities about it. And when I look back at it, the board was they had a board that was made of industry science, really great brand name companies and politicians. And you know, it's a business that I don't think I would have actually pulled the trigger on it, not for their big background that kind of behind it. And did pull the trigger, and it's still ongoing, but it was a realization after that not to get too impressed by the brands around the business and get a little more deeper into the guts of the business and not let them get a pass on certain diligence that otherwise done. Because we came to learn we had done the diligence that we would have done and done it in your typical deal and not kind of trusted the fact that the board who were, you know, in 3 times telling us certain things, then we so that's my biggest regret is letting the shiny art style branding align the actual hard work of the diligence.
The company was there.
No, I don't. I want anything because they're just they're still around.
So I think we have to at least have an open SCB, but you don't all have to respond to it. I'll throw it to you in the line itself. What are the implications of SCB?
Well, I will tell you, it was the worst 72 hours of my career. It was an astonishing thing. I went to watch it. I teach a class at Stanford Business School. On Thursday morning, I taught that class. I was walking along. One of my co-teachers was on the phone with one of her portfolio companies. She says, "Hey, hang on a second, David. I hear that there's a run in Silicon Valley Bank. You know, have you heard anything about it?" I said, 100% true. You know, Y Combinator, Sequoia, Peter Thiel. She said, "Thank you, pull your money out." That's what was happening in real time everywhere in Silicon Valley. Within 24 hours, I forget what the number was, $70 billion was pulled from the bank, and it was insolvent. My personal bank account, my firm's bank account, 20 of my portfolio companies were sole source at Silicon Valley Bank in an amazing moment. So what do you do? And so we spent all of our time trying to make sure that people could pay payroll, because it also was incredibly inconvenient that people destroyed the bank 3 days before the 15th. Like, destroy it on the 2nd. Give us a couple of weeks to recover. But no, they had to take down the bank for payroll. And it was an astonishing time, actually. And I was on the phone every 15 minutes for 3 days. And then when the government announced that it would cover all deposits, which of course it shouldn't cover the shareholder, but it should cover the deposits. We all were unimaginably relieved. And then you say, like, okay, now what's new? What are we going to do? And the reality is, Silicon Valley Bank, most of the things Silicon Valley Bank does today, early stage loans, banking infrastructure for startups, et cetera, were imperative to get the market to where it is today, are no longer. Doesn't mean they weren't a great bank. It doesn't mean like they weren't doing a lot of smart things, but I can't think of a single thing they do today that there are not alternatives for today. And so the reality is, which is unimaginable.
So where are you telling your startups bank?
Well, it is an interesting question because the reason people banked at Silicon Valley Bank is because the big banks suck. And they still do, you know, and now they're still trying to work with startups. So there is no clear answer. It goes first Republican until it's starting. So yeah, so there is no clear answer. People will figure it out. And no one is, I will say that never before has there been a moment in time where you can peg the biggest behavior change, a single day where behavior changed dramatically across an entire ecosystem. There is no sole source banking company today. And there were, you know, hundreds of thousands, you know, sitting around the day before this happened. That's an incredible shift.
Okay, this supply charge and fund, that was one side of it. Should you guys see it?
I mean, it was definitely also Thursday. We got a lot of calls, 2 minutes. I spoke to founders, said, listen, I also have an independent law firm, said I'm trusting him. Our funds here. There's no fucking way, excuse my French, I think they're gonna let this fail. Like, you're not losing your process. I had no doubt. I was like looking online at the history of
It had never happened before.
if anything had ever happened, like there's just no way it's and so we were maybe overly so, but we were very confident that no one was going to never their deposits, like, and then there's big government to do that. So we were a little bit less stressed. It was more just inconvenience of like payroll, vendors, checks bouncing, stuff like that. That was more immediate to them. We were stepping in to help out, but it was obviously a quick stress and a quick resolution. And I think people that were most concerned were those that had credit lines, credit debt side. And we know a company, I mean, we're not invested in them. They had $100 million line of credit. They're teetering on bankruptcy now. They got full and they're in trouble. So that's where I can see real pain points that potentially can replace it. With SVB, they do a lot of deals that other banks or funds may not do, for other incentives or other reasons that other banks may not have. So I do think there will be a lot of companies that directly get harmed more on the credit side, not having the same SVB relationship. But otherwise, we're seeing, you know, a huge companies that deal with this kind of things, spread money across different things, etc. It was an immediate stress, but honestly, I don't know where the big full sense of confidence came from. We pretty much felt there's no way the government's not going to backstop that. I mean, they just print money fairly easily, so I'm sure it's saving money. So,
Jason, I want to go to the audience, so let's not concentrate better. Let's do specific on the story. Okay. Does someone on Zoom want to ask the first question? So we honor you and your virtual presence here. We mean it. Come on, go for it. I'm rooting for you. Otherwise, I'm gonna have somebody in the conference room, but in that little Zoom box there, ask questions. Okay, fine. All right, audience, go ahead. Somebody want to ask a question? Otherwise, I'll ask.
Great. Oh, I'm Henry Yen. I operate on. I work for the US City government, so I'm a observer on that side. Great panel. Are folks based in New York or California?
Yeah, I split my time now between, I live in Palo Alto and on 22nd and 10th. So that's my world.
I was wondering if you gentlemen would comment on the state of DCs in New York versus Silicon Valley. Are there any differences, advantages of being based in New York? I hear it could be wrong that New York is now #2 in venture capital funding and has surpassed Boston. So, any comments on the advantages of being a VC in New York and how you see the future of the ecosystem of the ecosystem in New York? Or
I can start this one. So I ran a startup here at U2, and I spoke to almost every VC that exists. And I spoke to a lot on the West Coast, and here's a distinction. The ones that are here in New York, most of them finance. That's the basic, most of them work at big banks. And where they're looking at companies is much more analytical finances and projections for the finances. They'll drill into those like nobody does. It's 10 years in the future. When you talk to all projections for real estate businesses are a little bit fuzzy to begin with, but that's a huge difference here in New York, and whether or not that helped or hurt them a little bit yet to know from this recent change. Maybe it's clear, yeah. It's probably moronic.
In the
yeah.
early stages,
Yeah.
as they screw up.
Whereas on the West Coast, they're much more focused on your addressable market. How big is your moat in that market? What is your vision to get into that market and grow it where you're going? How good is your customer base? How much they loving with your product that you have? And that's a very different discussion, right? I have two visions, one for the West Coast and one for the East Coast. And even to this day, when brands approach me, one's from the West Coast, you might not even see the financials until like your third call. It's unbelievable. Whereas the ones on the East Coast here in New York, it's everywhere. Here's our margins, here's our logs, here's every single distributor we're selling to, and here's our online sales, here's our retention, here's our CAC, any other metric. Whoa. You got it's very, very different on both sides. And I mean, there's some stronger opinion, but who's right about early stage businesses, but the approach is always to West Coast does a better job. Returns are higher, and they're picking brands that are better. And I don't know how long it lasts that New York keeps that focus, if that's the way it's gonna go. It's just one person. I love the New York VCs.
I encourage this.
Yeah.
I'll take it. Your serial notice.
Take it off, take it off.
You are 100% right. Your assessment, your budget work. Great. I cannot tell you how many had deals done diligence and asked for actual financials. They're around for a year or two, look at their balance sheets, look at their banks, and found 3 of this revenue. Their actual reported pro forma revenue is, and their real revenue, or contract that weren't real, or more than other spending money on companies. And the deals later got funded based on the vision and how big it can be at the moat, and it ended up blowing up in their heads. And we had a recent company that just got funded a substantial amount of fund that we know, as a matter of fact, they are, have fake customers, a lot of things. So I think there is a lot of your current diligence that, right? So it's the reader returns to, or it's so interest more than your West Coast. But also, it's not like they do it also. Some later stage more so than earlier. A lot of the early stage don't do it at all. They won't even ask a company for certain, what I consider basic diligence stuff. And it's really, it's concerning and surprising. So I in terms of New York, I think wherever it stands in the standings, I think New York is being viewed more and more as not a very friendly place to business. I think people are looking to other states. I know many other funds and companies that are not heading out the door or have headed out the door. Maybe similar to what I don't play with West Coast, I hear similar things, but so I don't think it'll be in place wherever it stands. But in terms of that, it's a really good assessment on what is stressed more. And I don't think you're stress mode better advantage for your market size. I think they overstress the financial side of things that you're your best form of but it doesn't mean that there isn't some value in assessing what the customers pay for things, what you're actually getting paid now, why you're not considering customers.
One of the reasons I turned to Twitter is that when I asked Ed and Jack what their business model was, they said we don't have. And I said, yeah, I get that. Like, I understand that you're going to focus on building your user base, but at some point there will be some native way to monetize the thing. However you think about it, they said we don't. So there are some times when you say, oh, okay, that's not really helpful. And I do think ultimately you do need to work. Going back to Theranos, no one did the work in Theranos. It's astonishing, and everybody should. That said, we've already had a conversation that makes 100% clear the difference between West Coast and East Coast. Your description of like, oh, let me tell you about this bad choice I made was a choice of company you funded. No one gives a fuck what you funded. All we care about is what you didn't fund. Those are the mistakes. If I had funded Facebook, I'm the king of the world. That was the best venture investment ever made. $100 million valuation went out at $100 billion. A $12.5 billion investment ended up being worth $10 billion. That was the worst day of my life. There is no terrible day in which I invested in a thing that compares to that day. VCs on the West Coast are 100% focused. How do I not lose this opportunity to transform the planet? And the things there's like, oh my goodness, I might be scammed. It's a terrible thing. You should keep it work. But so uninteresting relative to, oh my God, you mean Uber had a big market? Jeez, that was stupid. That was another one, like billions of dollars in outcome. But that was the third worst day because we also turned down Airbnb.
So let's get some more questions in. Go ahead.
What about
Do you want
management?
to introduce yourself very briefly?
Sorry?
Would you mind it just saying your name and introduce yourself very briefly?
Oh, yeah, sure. Victor Germack. I'm curious, you don't talk too much about management. You mentioned it a little bit, but it's like the idea, and then how broad a market, what's the addressable market, you get into all these financial engineering issues. And what type of return? What about management? Most companies need good management. Now, maybe if you have a really great idea, you can have shitty management, and maybe some of this is like part of that. Maybe some of these managers learn over time. We can certainly point to, I think, a few examples of that. But I mean, you guys don't talk about management. What's the role of management?
Well, I strongly believe great people is probably more important than anything. So to address that, but after you kind of evaluate very high level parts that you're looking for, but founders tend to not, first time founders tend to not know, like they have a great idea, they're really hungry. You can't see the hunger in their eyes. They're just excited. They want to work their ass off. They can't convince you. They have to convince their employees. They have to convince their team, they have to convince their customers that they don't have a product trust. It's kind of bare bones. They have to convince everybody around them that this thing is the next big thing. It's going to change the world. If you can't see that hunger in their eyes, things not doing. And so for them or a group of them, that's what you're really looking for. Is are you able to convince me like you're convinced up and down and around to everybody else around you? And I think that's paramount because ultimately they probably don't have a marketing background, a sales background, operations background, fundraising background, HR. They don't right? Like they have to hire great people to do that eventually, or put on enough hats and convince people they can figure it out long enough. But if they can't bring that team around them with their passion, the whole thing falls apart pretty fast. That's and I do believe they can be taught, like, and you can help them, or a good board or a good finance can help them, but only so much, and they really need to scale.
Yeah, when I describe what I look at, I mean, it's funny that you say that because it is a fair description of what you just heard. If you say, David, what do you look at when you're looking at companies? I say team, TAM, team. Team, total addressable market, team. That's the whole game. I invest very early stage. And so the question is, who are the amazing people who are going to build this? Are they doing something that has the capacity to be giant? Which is why I don't really pay attention to finances, because I've invested in 45 companies-ish in the 20 plus years that I've been at it. 2 have met or beat their plan they present. 2, 40 some odd have not. And by the way, 5 of them have been worth more than $1 billion. So 3 of them even with that, still end up being amazing goods. So team is everything.
So, take another question, just wanna say, I think this is all.
Well, we all agree with, I can't imagine any one of us different.
I meant to say that the financial point here is there something going on in the financial scene? That Thera knows, please, so I think we're all in harmony on that. Sometimes I like peacemaking, sometimes I like encouraging fighting, but as long as we all end as friends. Another question.
Mordecai Hartman, DC attorney, is there too much money in venture capital right
Now, right now,
still?
there was probably too much money a year ago for the number of, I think there were too few operators with good ideas that were trying to start new companies. I think today there are not enough money at all to support the ones that are not. I think a lot of good innovation is probably going to be heard. I can speak with the brand side, there's a ton of brands out there, both in Apple and CD generally, that used to get a ton of money, at least see if they could build an audience, build a passion for consumers. And today they're not going to survive another 2 months. And these might be the next Coca-Cola, Budweiser, like Mike's Hard Lemonade. We're not going to be there. Then they're really going to die out. And that's because there just isn't. If you talk to entrepreneurs today, they're probably having 1,000 phone calls before they're getting a couple of minutes, or even a few hundred. There's a lot of them at early stages. And it's just, I mean, it's the state of DC where it's talking back then. But right now, I think it's very, very difficult for early first-time founders with pre-revenue concept, slightly to raise the capital they need to get them to stay.
I think the most painful part about venture capital is that you see your failures usually faster than you see your successes. Right? Your failures happen usually pretty fast. If you're an early stage investor, you can't raise a Series A years later or so, and you don't want to keep investing in them if they haven't proven out what you believe would be the reason you invested initially. And you deal with that real pain point of why did these companies fail, even though all these other companies may still be successful and out there raising another round and really growing their market, etc. And that's just paper games while you're dealing with these actual failures that you're disclosing to investors, dealing with yourself and questioning yourself and saying, what are you wrong here? Better next time, etc. I think for a couple of years now, it's just, if you're a company doing anything, you added special words, you got blockchain with free, or whatever was, in vogue at that moment, no code, right? And people forget about it. It's blockchain, like no code is great, right? But essentially making different. But the point being was there was no reckoning for a lot of money being put out, and people just like, oh great, look, these paper games, right? Where those harsh lessons and failures turn, and the amount of capital out there was insane. And 2021, 2020 was very difficult to find a company that made sense. That it was just, now. We know quite a few funds that so you money every so often. They're just not getting officers.
Really?
Yes, Florida actually. That's something like crazy. I don't quote me on that. I just remember it was an absurdly high number.
That's bad.
It's very bad. Very bad. Yes, it's very bad, and you have a lot of funds that say they the capital call initially when they had their next capital thing. Their company funnel and their big refineries. We're seeing a fully honest feel that basically, at the moment of honesty, it's having capital do it. Capital interested. I don't want to speak and or LPs that don't fund. And I think it's harder for companies to get funding. And I think you also, it doesn't change the landscape of if you're a really good company, you're still going to have money available. Like if you're a really good company, in the market, real low, and you're an exciting growth number, there'll be money chasing you and get a very useful. If you're earlier stage, not good yet, trying to raise capital,
in this space.
It's gonna try to be a venture capitalist. Yeah, you have cash. It makes it very valuable investment for you. That your company survive this next period of time. I'm not gonna guess new limits, but some period of time, unless you're gonna be big things. Venture capitalists. So make a lot of money.
Yeah, yeah, proximity, no, nothing to it.
I focused on this for today. If you were starting a company now, what would be like three top tenets? What would you do in terms of funding and working with investors? And then similarly, I don't know if you answer with different. If you're an angel investor in an early stage companies and you're advising those companies, I don't know, be a different answer.
It minds people again, it's like, you know, there's nothing worse than working with people, you know, bad people who lie to you or whatever. And there's nothing better than working with people who are actually genuinely trying to help you be successful. And so starting the company, find amazing co-founders who would share your vision, but more importantly, share your values, because that's hugely important. And go find investors who share your mission, but more importantly, your values. And sometimes you don't have the choice, because sometimes you just need the money. And I totally get that. But sometimes you do have the choice, or you can choose where you start, or who you talk to, or how you build the team. And entrepreneurship is really hard. It's unimaginable to me that it ever. I truly think it's magic that it ever. And so, while you're in those trenches, fighting the fight, it matters here. And so I would start with it.
I would say, as important as that is really crystallizing and trying to get as much certainty as you can for yourself and for the customers on whatever you think that it really is about that needs and value based on whatever that is. Like really understanding your market, where you're like, you just have an idea and you have access to capital and the team is nice, and maybe you end up turning that into something real. But ensuring that there really is interest in what you're building, whether by your internal conviction of it or by actually testing the market and seeing that it's there for you, it really super valuable. Because a lot of times you get a pitch and have a nice pitch deck. They have some cool accelerator and fun behind them already. You can speak with them. Just trying to understand what is your value problem for yourself. How does how are you feeling selling that market really appreciate pay for that? Sometimes just that basic questions like little answers. Sure, like really haven't done, we can do this, and like well, you're just like an add-on, so like how do you make it so that each I think a lot of people want to build a company, so get a team and be able to raise capital, especially if you're not a lawyer background, you have some kind of network that will fund you, but then the idea is not correct. And then eventually I can so if you want to start a company, I would say never or something. Have an idea really crystal clear. If you're an angel investor, I'd say it's for advising. Tell your companies like they may have the easy capital. So if you're thinking of a crazy idea, a project that, especially on the sales side, like like sampling works, stores, just do that. There's no need to go buy billboards all around the city just to see if it's going to work today. Maybe we can do that. We may have a little bit more line of sight to where the capital is coming from. We can trial and here, and this applies to all groups. Right? Now's the time to focus in on what
You sample alcohol.
You haven't had a sample on the resort.
Guess that makes sense.
Next one.
This point, it's no, in the old days, it's like you're going to spend it and see what's working, try things, test things, figure out new things. So that's not the case today. So if you're an angel investor, you don't force it on them. Like advise them, like I've heard this.
I think we'll end it after your questions. There's time. round. Do you want us to? Great question. Okay, so we'll squeeze you in, and then other questions people can ask informally. I just want to keep that final speed and not to way over. Go ahead. Thanks.
Steve. Similar, that's a shit. Preparation. How we see this side. On the legal side, whether.
Guided directly, or it's more conservative path to go to the EC.
Yeah, it's interesting, it's not the demos for easy lawyer, but sort of bad. Yeah, anyway.
I mean, I was easy, I was.
Yeah,
right, and it turns out it's actually super valuable once you become a VC, it turns out you know all the things you need to know about funding the company, it's a teeny piece of it, but literally, as I was walking to the subway to come here, I got on the phone and left a voicemail with the guy that said, you know, there's participating preferred and then there's 3x participating preferred and both are grotesque, but I can't imagine we're gonna accept the two of them together. So tell them to pick which of these shitty things they want, okay? That's a very if you're doing venture law, that you know what that means, you know where it is when someone proposes it, you know how pernicious and moronic it is, and you can have that. So that's great. The real question is, who do you, and if you are someone working with a lot of great companies and going out of your way to be helpful to them at any time and in any way you can, then they will come to trust you. They will call on you to do more, and you'll get to know them, and get to know the other people of the company, their friends, and that's how you build your reputation. And then you go in-house, and you go to your favorite client, because that's the best way to say, oh, I guess I'll go work at my favorite client. Sorry. That's something you could do. You could do that thing if you were not disloyal and terrible. It's great.
Back to the firm, Dave.
That's true. Anyway, so I do think there's an opportunity. I think it's all about relationship.
And I can't recommend enough. Any that shows. Or you gotta go to these those if you stay with me, you really get an understanding of what this is supposed to. Like they're generally just kind of in their own mind, they're kind of doing stuff, and by and large, when you're on these deals, investing or acquiring, you learn your background. You're like, I'm the smartest person in every room I walk into, and that's a weird, like you kind of like they start turning to you with like how to do the deal. This is smart. Like what's wrong with this company? And all of a sudden you're like, oh, I need to be an expert in a lot more fields than just how to get a term sheet done or how to execute on the outside counsel. You become much more wide because you become the source of smartness in the organization. And that's a huge amount. Not to mention just becoming a specialist in the field that you're trying to get into in this corporation or venture fund. So I highly recommend if you have that opportunity. That's a big push. From the legal side, you may not be getting quite enough into, but like I did some of this kind of things, it was at a bigger level, but like you may not be getting just quite the adventures a little bit, like we were talking about, team, like you're not getting it as a point. You're not feeling what that means or what's about. So like you're really trying to hone those skills, being a little closer to it.
And Bob Nagny helped me, Associate General Counsel at AIG. I wanted to ask you a little bit about the team, right? So we talked about communication, we talked about hunger, but what else are you looking for? Do you have preference to like Harvard, Stanford kids? Do you what else are you looking for in these founders?
I'll say that there are a lot of successful founders, very different personalities, right? So in very different backgrounds and lack of education. I don't think any of those alone make it big. It's helpful to certain indicators of some background knowledge. Someone has a PhD in physics, which helps to know that rockets, they're probably have some basic knowledge of that space, then I'm very sure it is. But I mean, first of all, it's just relationship. There's a lot of deals we just so right. See it. We can't see ourselves partnering with a company for the next how many years. We can't get along with them, or they're super stubborn and not. We common traits that we believe are a good recipe for success. Most importantly, really ingest views that are different than yours and analyze that and say, okay, here, we want to invest it. We have one of our most successful companies has a CEO, who's an engineer, is very inclusive, quiet, not like your typical leader, right? His employees are not like, oh my God, I love this person. I want to, they're so inspiring. He speaks in straight monotone. But he's doing a great job. He's a rocket. He's doing a fantastic job. He's great at building his company, understands his niche market, he's honest, he listens to critique, just, so I don't think there's any one thing, but the ability to listen, especially to your own employees who are doing it or with you, like they have ideas, they're speaking to customers. Just that the ability to see the market, see change before it happens, build new products that complement you have ready before someone else does. Really just good business market sense, real, like you talk about management before, like kind of when I hear the word management, I think of like corporate managers, private equity fund putting their suits and in managing the company well. Like that usually doesn't work well in a founder setting, at least at that early stage. It's not someone like with a specific management skill, but more someone who just has the ability to really understand their market, understand their product, and just underuse and act.
I'm gonna jump in on this question also. So we talked about the patina of these fancy bankers. There is, I think, a tendency, I certainly have it, to overweight our kind of pedigree education and see it as kind of really, setting us apart. There are a lot of awesome, really capable people there, and often it's the once you have a certain amount of intelligence, it's kind of the behavioral characteristics that are much more important. Where you went to school doesn't tell you that much about that, and so there are so many awesome folks out there. Interacted probably in the past 2 years with I don't know, maybe over 1,000 people, and just seeing where people come from, and successful people come from all over. There may be there's some selection, a lot of intelligent people, but it's like Harvard, see, more successful people from there, something statistically, I don't know, but there is a tendency to look at those signifiers maybe a bit too much, and there's really a lot of awesome people coming from all sorts of pathways.
Look, I'll say, you actually already heard it, which is great entrepreneurs are good sellers. And there are all sorts of ways to sell. There's some people who are kind of soft sell, and some people are hard sell, and some are managed, and some are not, but as I said, it's an impossible job. The only way you can do it is by convincing someone to do something irrational, to give you a bunch of money, convince your employee, people to come join you, and they could have a safe job, convince a corporation to use your thing, even though that's all these things that you have to convince someone to do that are crazy. You need to be a great salesperson. And the good news is that the very best way to figure that out is they have to pitch you and tell you and convince you to give them money. And if they're not good at that, they're not going to be good at the rest of it. And then you get to judge them. I'm talking to an entrepreneur right now. And I said, I want to do some references on you. And he said, absolutely, of course, but for what it is worth, 18 of the 25 people in my company right now I've worked with in Gerstel. Oh yeah, that's pretty good. Now I'm going to go.
Okay, awesome. So, Chris, we still have